Hey traders, a very warm welcome to you. So in this video we are talking about 7 mistakes to avoid when trading Forex. Now to be honest, it could apply for pretty much anything, but I know Forex and currencies is popular with you guys out there, very popular at the moment generally with the trading world. So let's stick with this. Right, let's get started. Number 1. Poor risk management. This is the biggest out of all of them. By the way, these 7 are kind of just the 7 biggest ones that I see. I've made all of them, honestly. I'm sure you have too. If you haven't, you will. And it pays to kind of get these in your mind, because if you can get these down, then you can make a lot better progress in your trading. Anyway, let's get on with it. Number 1, poor risk management. We see this all the time, guys, and this is the number 1 thing that's going to kill you. If you haven't got a good grip on how much you're risking per trade, how much you're risking per week, per day, per month, whatever it may be, you will end up in the heap and pile with every other guy out there who's tried currency trading. This is the biggest one I can say about all of them, because if you have the best strategy in the world, you could have the best, most brilliant, ridiculously high probability strategy, there will still be a string of losing trades in that strategy. And the problem is, if your capital is X and you're risking way too much, and your risk management is or maybe you're going erratic with your risk management. Some days you're risking 10X, some days you're risking X. You're all over the shop. You know, it doesn't matter what the strategy is, you will lose eventually, because just purely by the nature of probabilities. You can have a really good high probability, but you're going to have a sequence of losers. And if those losers take out your trading capital, it's game over. So really being strict and structured with your risk management. So, you know, the biggest mistake I see with guys is that the risk management is just poor. You know, just go into it and don't think about what their risk allocation is to kind of each trade, as I say, each day, each week, each month. Right, number 2. Not sticking to your plan. Listen, we've all been there, and we've all kind of, when the market's closed at the weekend or whatever, we're there and you're locked away in your office and you write a nice trading plan of what you're going to do, where you're going to go, how you're going to manage it, you know, and you kind of branch off, and you might even do a kind of flow chart of what you're doing, or you might even just do a couple of points and then go, whatever it may be, you've got a plan of what you're going to do. And then of course Monday morning comes and you end up doing something completely different, or later in the week, maybe you stick to your plan for a little bit and sometimes you deviate. The whole point of the plan is that you need to stick to it. If you don't stick to it, you're not trusting your ability to make the right judgment. You know, if you think about that, you think about going into, without going not too deep about this, guys, because we're going to cover them all, but just think about that for a second. If you don't stick to your plan, you're not trusting your own judgment, because you're basically overruling your plan in the actual heat of the battle, so to speak. So market's moving around, you know, you can see your US dollar spiking up and you think, oh, I think it's going to go high, and you chase it. And the big thing in your plan number 1 says, don't chase the market, wait for a pullback. And you've already ignored it. Now, subconsciously, you're not trusting that your plan is going to give you the pathway to profitability. And that's something you need to address. But anyway, we've got tools and tips and tricks for that in the future. Okay, not sticking to your plan. Big one. Can't emphasize that one enough. Okay, number 3, we've got averaging down. Huge one. This it's kind of a little bit similar to kind of, you know, not sticking to your plan, but averaging down. And I should kind of say with no structure or no kind of plan behind it, because I've seen guys wipe out with this. If I'm honest with you, I've seen guys who have just ended their career doing this kind of thing. It's sad to see, but it's quite a common thing, which is why I've got it here at number 3. Go into position, goes against them, add a bit more. They're really in the position they didn't want to be in. And if you go back to some kind of, if I don't know if you guys know of Mike Ashley, who was trading HBOS during the financial crisis, he was adding to his position, he ended up losing 200 million. Extreme, I know. We're not likely to lose 200 million, nor we have 200 million to lose. But the point is, whatever your level you're playing at, when you're averaging down, you're doing it out of hope. There's no, if you said to yourself, hey, listen, was I expecting to do this? Was I comfortable with losing the amount I've lost at the moment at the beginning of the trade? If the answer to that is no, you need to be cutting the trade. To going in, averaging down, believing that you're going to be right, the market as a way of just brutally telling you you're wrong. And we know that markets, you know, they transition from kind of chop to trend, and the likelihood is if you're averaging down, you're going to be averaging down or averaging up, depending on whether it's short or long. You're going to be averaging into a trend. You're going to be far too big, far too soon. Because the common thing as well with averaging, guys, is that most people will average a bit too aggressively, too quickly. They'll double a position. Before you know it, they've got a really big position. They haven't really got enough room to ride out noise, and then it becomes a game of luck. So being very careful about averaging down. Number 4 we have is chasing market moves. Big one. You know, I've been guilty of this as well in my time. I'm sure you have too. And it's something that once you button up well, you see some big improvements. So chasing the market moves, when the market starts driving off and you think, okay, I want to be a part of that, I want to be involved in it. You know, you need to have a strategy that says, listen, I want to get involved on pullbacks, or I want to do this, I want to do that. You need to kind of define so you're not chasing, because the bad thing about chasing is that obviously it's by the very nature of it, it's not going to work for you if you repeat that kind of action over time. And that's the point with trading, guys. It's not what's going to work for you now. It's if you do the same behavior multiple times, will it work out for you? And chasing the market, you know, never works over time. You always have to have a plan to be, you know, where can I buy it on a retracement? Do I want to look to, you know, because otherwise you're just joining the crowd of euphoria. And okay, I'm being a bit broad with chasing. We can define it as various things, but you know, I'm saying that you know when you're chasing the market, you know when the market's run off and you feel like, oh, I want to get on this. I thought it was going to go. I don't want to miss it now. That's chasing. You know what that's all about, and honestly, avoid it at all costs. Okay, we've got now number 5 is trading news releases. Now I know there's some guys out there who actually trade it a specific strategy on news releases, and that's fine. You know, if that's your bread and butter, that's fine. But for most traders, trading news releases is damaging. And I bet if you went back and you got your statements and you compiled them all and you saw what was going on, you would see as well that trading news releases was not good for your long-term success in trading. Markets spike up, markets spike down. They do all over whatever they want to do. It's run by algos, taking out stops, this and that and the other. Sometimes they'll continue because it's good. Sometimes they'll come. You know, it's a very tricky thing. And it's not to say you can't master it as a potential skill on its own right, but it's a very difficult thing just to bolt in and say. Most people are way, sort of 90% plus Forex traders out there are better not even touching news releases. Let it settle down, let it maybe settle into a trend. There'll be a trade after it if it's genuinely some sort of reprice scenario that you can get on board. But trying to scalp the news release is a tricky game, and it's really for kind of advanced people. At the end of the day, it doesn't really matter how you make your money in the market. You know, okay, we can say it's an advanced strategy, whatever, but who cares, right? If you've made 100 pips by trading a nice, simple pullback strategy, the simplest thing ever, you've waited for it and you've cleared 100 pips, beautiful. You know, it's exactly the same 100 pips as someone who's scalped 25 at a clip trading a news release. It doesn't matter. It doesn't matter where you get your money from. So focus on the easy money. Okay, number 6. Not keeping a good journal. Big one. You can't improve something you don't measure. If you don't measure it, you can't improve it. So, and also this comes of measuring your kind of your mindset in the trade, the trade you're taking, the strategy that was for the trade, the kind of day. You know, we're not going to go into what you need to be putting on the journal here, but keeping good records, good journals about what's going on with your trading, because you can't measure it, you can't improve. Okay, finally, number 7. Trading too much size, or using too much leverage. So it's kind of a little bit similar to risk management, but I've added it again because it's so important. I've seen this so many times, guys, is that, you know, people trade way too much size for their account. Listen, I know we all want to make as much money as possible, right? That's the game. And you come in and you've got a small account and you want to kind of make it into a big account. And it is possible. It's definitely possible. It's possible to do it, but you have to do it in a much more structured way than just piling in a big size, thinking, well, I need to make, you know, 500 quid on this trade, and your account size is only a couple of thousand. You know, just the pure probability perspective of that means that you're going to wipe out eventually. And it's so psychologically damaging. You know, I know a guy who was trading very well, doing kind of a pound a point spread betting or 1 CFD or whatever, how you want to wrap it up, whatever you, however it works well in your mind. But he was spread betting. He was doing a pound a point. He was doing very good trades, a couple of 3 or 4 weeks. I think it was a very nice trades, building his account up. And then he decided to jump to £10 a point, and of course, you know, wiped out quite a lot of his gains, and it just didn't like the whole feeling of that. So, you know, that happens to a lot of people. They focus on making the money as opposed to improving as a trader and knowing that the money will come eventually. So, Trading too much size for your account is a big one, and also too much variation. That is a skill in itself, and you've got to be careful you don't suddenly start swinging your position size up from low to high, because obviously that's going to have a massive effect on previous trades in your account. And trading too much leverage, obviously, currency you can trade massive amounts of leverage, guys. You can pretty much put your whole account on one trade. It doesn't make any sense to do that. It's not going to help you long term. It's just generally a bad idea. The reason they do that is because obviously, you know, the reason their brokers allow you to do that is to say, listen, you're a big boy, you want to play the game, you can play the game. We're not going to restrict you to how much these are restrictions on leverage, they're pretty big. And if you go max leverage, then you're going to end up wiping out. So be very careful with it, guys. Just because it's there, don't necessarily use it. Focus on doing the right thing at the right time, and believing that ultimately, you know, if I do the right thing at the right time, develop my skill level, then eventually the money will come. I can trade with more realistic size and more consistency, as opposed to hoping for those big wins. All right, guys, those are the 7 mistakes to avoid when trading Forex. Hope you enjoyed and get a thumbs up if you did. Don't forget to subscribe if you haven't already for more videos from myself and other traders on this channel. Comments below, always welcome. Take care, good trading, see you soon. Bye-bye.